could do well.
Well, joining us now in studio to help analyse the numbers is Nkareng Mpobane, Portfolio Manager at Ashburton Investments, to help analyse Discovery's full-year results. Nkareng, maybe if we take a look at a general overview of the firm's numbers, it almost seems as though there just is no stopping this giant machine that is Discovery.
Certainly. I mean, as you mentioned, the headline earnings numbers, so normalized operating profit, which is the metric that we would look at it on, so normalized operating profit up 23%, which is quite strong at a group level. And then you still see new business growth of around 15% at an overall group level. Again, a strong number in quite a benign South African economic environment. So certainly from that aspect, the numbers look great. From our perspective, we have somewhat reduced exposure and maybe readjusted the exposure in Discovery.
Why?
So there's certain segments of the business that we are concerned about, although maybe I can start with the upside in Discovery being the growth areas in Discovery, so looking at the joint ventures, what they've called the partner markets, so China and the Ping An joint venture, and then the AIA joint venture in Southeast Asia. Obviously those are GDP, economic growth forecasts in those economies are very robust. Insurance penetration in those markets remains very low. So obviously it's a good story in the medium to long term for a company that establishes a footprint in these markets. So it's difficult to maybe factor in growth with these ventures in these numbers currently. So you probably don't put much value in those operations, but certainly in the medium to long term, we like that story. We think that if they get it right, you could realize very good synergies out of it. I mean, the AIA business, for instance, it's really premised on Vitality really working out for Discovery. So any new business that's written due to Vitality and any persistency improvement in their book, in AIA's book, due to Vitality, that's when Discovery starts realizing profits out of that business. So, and Vitality, we agree, is a very good, it's an innovative product, which is new to the insurance industry, was new when it was launched to the insurance industry, and many of the insurers attempting to replicate it. Our concerns probably lie with what is still a significant part of Discovery's earnings, which is the SA Life business. So SA Health, as you said, the health business up 10% off a very high base. I mean, it's a market leader in the SA health insurance space. And still very good and strong cash generation. But within SA Life, we're concerned about that cash generation. So as you know, they have this model of pure risk business, and they've been forced to perhaps have to in bringing the forecast profits into present value, they've had to really extend the life of those profits, so go quite far into the future to PV those profits, unlike other insurers, for instance. And I mean, the new business strain, for instance, so the cost of writing business for them, it's not put through in the earnings. It's actually financed through reinsurance, which we saw in last year's numbers. So until maybe Discovery, you know, in time, we think that they are likely to realize cash out of this business, but to date, we haven't seen anything come through yet, and they are finding different solutions to financing, for instance, as I said, the new business strain. So
I want to bring Mark in here for a moment. Mark, do you share Nkareng's concerns with regard to Discovery Life, or are you slightly more optimistic on the company?
I was interested, about 500 million or so of the normalized profit increase was attributed to Life. On the surface, that seems a good figure, but Discovery can also be a little creative, shall we say, with the way it produces its earnings. Perhaps for the benefit of the viewers, you could shed some light on that too.
So, for instance, if you then look at the notes in their annual report, for instance, you need to maybe compare their assumptions with regard to, say, valuing their embedded value. So you might notice that their risk-free rates, or their discount rate that they use, is somewhat lower than what the industry uses, for instance. So in this latest figure, I think they're using risk-free plus 1.4%, where you've seen the SA government 10-year bond yield increase by 80 basis points. So you would expect that instead of 1.4, this number is somewhat a bit higher. So that obviously improves their embedded value assumption. And then again, as I mentioned, where they're showing very strong growth of net operating profit, normalized operating profit of 23%, that has not yet taken into effect that it hasn't accounted for the new business strain, the cost of writing the business. So those are some of the concerns, and also maybe in the UK life operation, the Pru Health, also maybe cash concerns in that business.
Despite reducing your exposure to this company, it sits on a PE of 22. Yet today, the share price has gone up by at least 18%. Mark, is this one that you would still consider keeping in your portfolio?
It's an interesting one, because if we take diluted headline normalized earnings, whatever figure you want to choose, you know, you're looking at a forward of about 700 cents per share, somewhere in that region. So at 100 rand a share price, you're looking probably at a forward P of close to 14, I'd guess, somewhere around there. The yield is quite thin, though, Gugu. I mean, you know, I think on a net basis, 1.3%, something of that order. So on a forward, say 1.5. That kind of suggests to somebody who perhaps doesn't know the business that intimately that the lower yield corresponds to a high growth company, possibly, the retaining cash for growth. And so therefore one could argue at, say, around the 100 rand mark, you know, ostensibly rich, but if they can continue with this growth trajectory, perhaps not too bad value for money.
Exactly. And maybe that's why what we've accounted for in reducing that exposure to Discovery. So we haven't completely moved out of it, but we do note that it's, you know, they continue to report in excess of 20% earnings year upon year upon year. But we think that as the years go on, the market starts questioning perhaps even the dividend yield story, in that your growth areas, it's likely a few years ahead, and where's the growth now, and the big parts of this business being fairly mature businesses, so the health and the life, we need to see growth there, and then give cash back to shareholders, but then we're concerned about the cash generation of it. So these are the question marks around it, perhaps.
Maybe that's what keeps Adrian Gore up at night. But Nkareng, thank you so much for your time this evening and joining us. That was Nkareng Mpobane, Portfolio Manager at Ashburton Investments.